Section 7:2 Introduction to Modern Portfolio Theory, 7.2 Criticisms of MPT. Modern Portfolio Theory, MPT, has received both praise and criticism since its introduction. Some of the criticisms of MPT include assumptions of rationality. MPT assumes that investors are rational and make decisions based on expected returns and risk. Critics argue that this assumption does not fully capture the behavioral biases and emotions that influence investor decision-making. Behavioral finance research has shown that investors often deviate from rationality and exhibit biases that can impact portfolio construction. Estimation errors. MPT relies on historical data to estimate expected returns, volatilities, and correlations of asset classes. These estimates are subject to estimation errors, particularly during periods of market turmoil or when market conditions change. The accuracy of these estimates can significantly impact the optimization process and the resulting portfolio allocations. Sensitivity to input parameters. MPT is highly sensitive to the input parameters used in the optimization process, such as expected returns and correlations. Small changes in these parameters can lead to significant variations in portfolio allocations. Critics argue that these inputs are often uncertain and difficult to accurately estimate, which can undermine the reliability of MPT's optimization results. Normal distribution assumption. MPT assumes that asset returns follow a normal distribution, which implies that extreme market events occur with very low probabilities. However, in reality, financial markets experience occasional extreme events that can have a significant impact on portfolio performance. This assumption may underestimate the potential downside risk of portfolios. Lack of consideration for tail risks. MPT does not explicitly account for tail risks, such as market crashes or extreme events. These tail risks can have a disproportionate impact on portfolio returns, but MPT's optimization process may not adequately capture these risks. As a result, portfolios constructed solely based on MPT may be vulnerable to severe market downturns. Practical implementation challenges. Implementing MPT in practice can be challenging due to several factors. These include the need for accurate and reliable input data, challenges in estimating parameters, difficulties in effectively diversifying across asset classes, and constraints imposed by transaction costs and liquidity. These practical limitations can make it challenging to implement MPT optimally in real-world investment scenarios. Inability to fully capture market dynamics. MPT assumes that asset returns, volatilities, and correlations remain constant over time. However, market conditions and dynamics are subject to change, and correlations between assets can vary during different market environments. MPT's static approach may not fully capture these dynamic market behaviors. It's important to note that while MPT has its criticisms, it still provides valuable insights and serves as a foundational framework for portfolio management. Many of these criticisms have led to the development of alternative portfolio construction techniques, such as factor-based models, risk parity, and adaptive asset allocation, which aim to address some of the limitations of MPT. When implementing MPT or any portfolio construction approach, it's crucial to consider its assumptions, limitations, and potential biases. Investors should evaluate the appropriateness of MPT in their specific context and consider incorporating insights from other approaches, such as behavioral finance or alternative portfolio construction techniques, to enhance the robustness and effectiveness of their investment strategies. Alternative investment strategies can play a role in addressing some of the criticisms and limitations of modern portfolio theory, MPT. These strategies offer potential solutions to challenges such as estimation errors, sensitivity to input parameters, lack of consideration for tail risks, and the inability to fully capture market dynamics. Here's how alternative investment strategies can help address these criticisms: diversification beyond traditional asset classes. Alternative investments, such as real estate, commodities, private equity, hedge funds, and infrastructure, provide opportunities for diversification beyond traditional asset classes like stocks and bonds. By including alternative assets in a portfolio, investors can potentially reduce the reliance on the estimates of expected returns and volatilities of traditional assets, which can be subject to estimation errors, non-normal distributions, and tail risk management. Alternative investment strategies can help address the assumption of normal distribution and the lack of consideration for tail risks in MPT. Some alternative assets, such as managed futures or tail risk hedging strategies, are designed to provide protection against extreme market events and downside risks. These strategies explicitly focus on managing tail risks and can enhance the risk management aspect of portfolio construction. Dynamic and adaptive approaches. Alternative investment strategies often employ dynamic and adaptive approaches to portfolio management. Instead of assuming static correlations and market conditions, these strategies continuously monitor and adjust portfolio allocations based on changing market dynamics. This allows for a more responsive allocation that can capture evolving correlations and adjust to market regimes, potentially addressing the limitation of MPT in capturing market dynamics. Factor-based investing. Factor-based models, a type of alternative investment strategy, offer an alternative approach to portfolio construction that goes beyond traditional asset class allocations. By considering specific factors such as value, size, momentum, or quality, these strategies aim to capture risk premia associated with these factors. Factor-based investing can enhance diversification, provide exposure to unique return drivers, and potentially improve risk-adjusted returns. Risk parity and alternative weighting schemes. Risk parity strategies, which allocate based on risk contributions rather than market values, can provide a more balanced risk profile across asset classes. These strategies aim to address the sensitivity to input parameters and the potential bias introduced by traditional market capitalization-weighted approaches. Alternative weighting schemes, such as equal weighting or minimum variance, can also be utilized to enhance diversification and reduce concentration risks. Private market investments. Alternative investments often provide access to private market opportunities, such as private equity or venture capital. These investments offer potential diversification benefits and exposure to unique return drivers that may be less influenced by short-term market fluctuations. By incorporating private market investments, investors can potentially mitigate some of the limitations associated with public market investments and enhance portfolio diversification. It's important to note that alternative investment strategies come with their own set of risks and considerations. They often involve higher complexity, less liquidity, and may require specialized expertise for effective implementation. Due diligence, thorough research, and careful evaluation of the specific characteristics and risks associated with each alternative investment strategy are essential. By incorporating alternative investment strategies alongside traditional asset classes, investors can potentially enhance portfolio diversification, mitigate specific criticisms of MPT, and improve risk-adjusted returns. However, it's crucial to consider individual investor goals, risk tolerance, and specific market conditions when selecting and implementing alternative investment strategies as part of a portfolio construction approach.